Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Ira Harris and Peter Boockvar. Ira is an independent trader, successful hedge fund manager, global macro consultant, trading foreign currencies, bonds, commodities, and equities for over 40 years. He was also CME director from 1997 to 2003. And Peter is the chief market analyst with the Lindsay Group and the co-chief investment officer with Bookmark Advisors. Peter has a newsletter product called the Book Report, spelled Book, B-O-O-C-K, report, all one word.com. It offers great macroeconomic insight and perspective with lots of updates on economic indicators. Welcome, gentlemen.
Thanks, Rich.
Thanks, Rich. Thanks for having me.
Great. I thought today we'd start off with a quote that you had in your recent writings, Ira, on flattening yield curves. It's the ECB and Bank of Japan policy that is flattening global yield curves as investors search for extra yield. And you made the analogy to something similar which may be happening to 1994 Orange County bond disaster. Just wondering if you could elaborate on that, your thoughts.
Okay, so when we look at this, we're comparing it to Orange County. I do, because that was a classic case when the bond we don't call them taper tantrums back then. I guess it was actually a meltdown as the Fed started to raise rates and everybody was crowded into a bond trade, and we saw the yield curve steepen out dramatically, even though it was a short end because so many people were crowded into that trade. But what you really found out and what Orange County exposed is that Robert Citron, who was the treasurer for the Orange County at the time, was busy chasing a little bit extra yield, 25, 30 basis points. And there were many firms, sell-side firms, who came to him and they were offering him these products, and they were exotic products, very exotic at the time. And so in order to please his bosses, he chased extra yield, and very little, 25, 30, 35 basis points. And I know this from Sheila Baer's committee, which I sat on in Washington, in which we analyzed what went wrong there. So I had a pretty good behind-the-scenes look at it, and it reflected in that. So when I look at the world today, and I know Peter's written about this is a real problem, is that people are taking on so much risk in an effort to chase so little return. But in a world where Italian bonds are 175, 10-year notes in Italy are yielding 1.75, you take on all kinds of risk as you search for an extra 30, 35 basis points, because 35 basis points in today's world is a lot. And for those who are trying to outperform the market, and these are people who manage institutional money and big pension funds and insurance companies, they are taking on a lot of risk. And that's what I'm really that's what keeps me up at night. And I think we're getting close to crunch time, in which some of these trades, as Warren Buffett would say, when the tide goes out, you find it swimming naked. Well, I don't think there's many bathing suits that have been sold at all. So I think we're probably more at what is that, Club Hedonist? I'm too old to know and to partake in that, but I think we'll find out that there's a lot of nudity in the waters of central bank liquidity.
Peter, do you see a similar 1994 Orange County environment?
I like that analogy, Ira. That was great.
Thanks.
Yeah, I do. It gets to follow the money. Okay, so next year, even in January, when the ECB cuts their QE in half and the Fed goes from draining $10 billion a month to $20 billion a month, liquidity is going to go to almost zero between those two central banks. So that's a major change. I mean, this year on a run rate, the ECB was buying north of 700 billion euros of securities, and that is, and then you subtract. Well, you cut that in half next year, and then you subtract what the Fed is taking out, and that is almost going to nothing, and that is a really big deal. At the same time, the Fed is raising interest rates, and the BOJ is buying less ETFs, and they're buying less JGBs. That liquidity flow is going to turn into a drip next year.
And
which leaves no room for error anywhere else.
Yeah. What about if we look at the U.S., Ira, you asked how does the Fed deal with a flattening yield curve in your most recent writing, noting it's gone lower than 73 basis points. Any thoughts on that? I mean, you did suggest something on the cutting the short-term rates on that to make it similar, steepen like the German 210s.
Yeah, because I compare it to and Peter and I actually went back and forth with this yesterday on it, because I showed him that German 210 versus U.S. And if you would make if you were a wagering person and you said, well, the ECB is doing all this buying, the Fed has, as Peter says, has stopped, and in fact is now contracting its balance sheet, you'd say, wow, the long end in the U.S., the curve should actually be steepening in the U.S. based on those mechanics, and it should be flattening in Germany. But it's absolutely the opposite. German curve is out to 3-year highs at 110 basis points, while the U.S. curve, as you rightly talk about, is at 70 basis points and flattening. So when you look at this, it is, what was the word you used yesterday, Peter? Because it was absolutely right. You said this was like wild. I said, yeah, it's exactly what it is, because it makes very little sense. It makes, in fact, no logical sense whatsoever. And I don't know how the Fed, Jerome Powell is going to have to face this, because, listen, the Fed has already told us they don't understand, that their models have been wrong, and they really don't understand what's going on in the inflation world. They don't understand it. So now are they going to tell us that they don't understand why the curves are flattening? Because when you look at it and you throw in this tax plan is not tax reform. It's tax cutting, and it's stimulative. By everything that I hold dear to me, this curve should be steepening dramatically. Bonds should be getting terrified of what they're facing. And as Peter says, next year they're going to be shrinking it. This curve should be steepening, and yet it's not. So if they do, and then they're going to tell us they don't understand what's going on with the curve. And I know that the curve is one of their big indicators. So if you don't understand that, and you don't understand inflation, you've made a $4.5 trillion wager on the effectiveness of the QE programs. That doesn't sit well with me. So that's where it leaves me. So you can either cut rates, which would throw the markets in absolute turmoil. So, and that's just the way it is. There's nothing else they could do, or they can, as I say, they could increase the amount that, I say, if next January, if the ECB we know is cutting to 30 billion, well, maybe the Fed should just ramp up to 40 billion and always be selling more than the ECB is buying, and you'll get the curve to steepen. I guarantee that.
And Peter, your thoughts?
Yeah, no, I agree. Just to quantify the dramatic effect that the ECB had on the entire yield curve in Europe relative to the U.S. And the Fed, is that the Fed, when they were doing QE infinity, aka 3, they never bought more than the net issuance of debt that the U.S. government was issuing. In Europe, the ECB was buying 7 times the net issuance. It was just so dramatic. It was literally the elephant that was stomping everything in its sight. And granted, having negative interest rates continuing to 2019 will certainly keep a big anchor on the short end. But because of the dramatic extent that the ECB was buying bonds, I have to believe that there's going to be some response on the flip side when they stop buying bonds. Now, again, the negative interest rates in the short end will be an anchor, but imagine even when that ends. I mean, one thing that we have to take note is Draghi is now becoming more defensive about negative interest rates. He's now having to explain himself. Here we are. This is 3.5 years after he initiated negative interest rates, and he's still defending negative interest rates. You have the European Bank Stock Index that is still below where it was 3.5 years ago. So I think that the politics around negative interest rates will get more and more difficult as bank profitability continues to be under pressure. And there's no question that accidents are going to occur here. None of us are smart enough to know how it exactly plays out. But come January, when things are shifting in a more dramatic fashion, I think everyone has to be really, really careful.
And so what will happen, your thoughts on the new Federal Reserve Chairman nominee, Jeremy Powell? How do you see his policies, and what will his monetary policies be like in the coming years? Ira, you want to start?
Oh, you know what? I'm not sure. My first glance, I talked because when I had the opportunity last year to directly ask a question to Jerome Powell, about who guarantees the ECB. It was a two-part question that I asked him, which was who guarantees the ECB, and do you think that all sovereigns should carry a zero weight? Because I know what his expertise is or his strength is within the Fed, and he said. I was wild about the answer, so I've given him some crap, but I do think that he's a good choice because he's very pragmatic, and I think he'll know how to adjust, or hopefully. So his response to me on the ECB was they have a printing press, which he didn't even have to think about that. That came right to him, and the fact that they're zero weighted, that's all we have to care about. They're zero weighted, and okay, I was never comfortable with those answers, but I think he brings more to the table. I think he is, unlike I think some of the people who do sit in that room with their high-level maths and PhDs are too arrogant for the job. I don't think that Jerome Powell is. I think Jerome Powell does know how to listen, and I think that'll be a great strength of that.
And Peter?
Yeah, I mean, I think while he is very similar to Yellen in that he voted for every QE. He voted for keeping interest rates at zero for as long as they did. He voted for the committee every single time. There is talk that he was not a big fan of QE, so that's a positive for the sake of manipulating markets. It won't necessarily be a positive for markets when we get the next 10 to 20% decline and everyone's screaming, "Oh, the Fed save us, the Fed save us." I think he'd be less inclined to be the market's sugar daddy, which I think is a good thing, but maybe it's not what the market necessarily wants to hear. Now, he's not going to obviously be as potentially hawkish as Taylor or Warsh would have been, but I think if the market thinks he's a Yellen lookalike, I think they may be a bit disappointed, and that he's going to be thinking more outside the box. And he's not going to believe in John Maynard Keynes to the same extent that Yellen has.
And just going along the discussion from Europe, Peter, you've written recently on how higher inflation in the Eurozone is a very underappreciated risk. Can you elaborate?
Yeah, I mean, I follow the market monthly numbers, and I like to read their commentary. Now, it's very anecdotal, so we have to separate the anecdotal commentary from business surveys that they do from the actual consumer price index that the Eurozone comes out with. But on Monday, we had the Eurozone Services and Manufacturing Composite Index come out, and I'll just read to you what the inflation commentary was. Inflationary pressures have meanwhile lifted higher, with price charges for goods and services rising at a rate not seen for over 6 years. Some price rises merely reflect the pass-through of higher costs, but companies are also reporting stronger pricing power as demand conditions continue to improve, which suggests underlying inflationary pressures are becoming more ingrained. Then yesterday, market came out with an index on German construction, and they talked about intense supply chain constraints contribute to sharp rise in input costs. The incidence of delivery delays was one of the greatest seen for over a decade, while purchase price inflation was pushed to a 6.5-year high. And they also reported a retail purchasing managers index for the region, and they talked about gross margins facing Eurozone retailers continue to be squeezed. Contributing to this was another rise in average input prices. Moreover, the rate of inflation quickened to a 57-month high and remains substantially greater than the long-run series average. So how that translates into actual inflation, I don't know. What PPI will eventually look like, what CPI will eventually look like, I don't know. But to me, when I read that, it tells you that there's price pressures that are brewing. You have the commodity index, the CRB index, closing at an 8-month high yesterday. So any potential surprise on the inflation numbers in Europe, I think will be to the upside, using this as potential evidence. And even with cutting QE by 50%, they're still going to be buying 30 billion a month, and they still have interest rates deeply negative. So they're wholly unprepared for a multi-month march to, let's just say, 2% CPI. And I think that is a major risk for the European bond market. And to me, the European bond market is the epicenter of the global credit bubble.
Do you see similar conditions, Ira, as the biggest bubble being the European bond market?
Well, yeah, Peter's been on the strength of growth and on Europe, as he says. He's been very bullish to European equity markets, but is more than a little concerned, as he's just talked about what the banks have done because of the interest rate policies, of course, of the ECB. But the issue where we may differ is, do I think that Draghi cares about what the inflation is? I don't think so, because I just as I've talked about, and Peter and I have discussed, I think with you, Richard, that he has a bigger thing going here, and that he's trying to load that ECB up with as much debt as possible, because as the only outcome can be, of course, would be the creation of a Eurozone bond, which they can't. The governments can't do it. The European Commission has not been able to move it forward. And the talk that came from Macron was to push it farther and faster. And there's of course, Germany is more than reticent, because they know what's going to be saddled here. So he keeps going and going and going. So I agree with Peter. Once we get over 2% inflation, I know what the response is going to be, because that's what they basically use the same kind of dynamic stochastic models that the Fed does, and they'll go, well, they'll call it transitory. They'll call it this. So if it's sustained, and I think Peter sees it being sustained, I'm not sure. He's much better at that, at discerning that than I am. That if it's sustained for 3 or 4 months, they'll have a serious problem. And you could see that there is pushback. He didn't talk about it at the meeting, but there were 5 dissenting votes to even the cut of 30 billion, moving from 60 to 30 billion and leaving the negative interest rates. And with all that forward guidance, there was pushback. And the pushback is coming from just where the sources, from the Dutch, the Austrians, and now we'll see even more from Austria because of their political situation. But Merkel's in severe trouble. She can't even. Germany may have to go to a new election because they cannot put together a coalition here, because the Free Democrats, first of all, they want as their cabinet post to be, of course, they want the Ministry of Finance, which Schweible used to run, and he was fairly hawkish, but they want more. And their issue is, of course, with the ECB and their overall policy and its effect on German savers. So this is very, very dangerous. In fact, one of Merkel's ministers, one of her close people, came out and tried to make he made a statement that was very tied to what Macron wants. And my first thought when I read that statement was, oh, what do they do? They're trying to lull back the Social Democrats. I don't think that's possible. So, because the Social Democrats would have to eat such phenomenal crow, it would be the end of them. They could be in this coalition, but they'll continue to lose power. But if Germany winds up going to a new election, Merkel's going to get trounced. There's no way, because she's losing her gravitas is gone anyway. So there's a lot of things yet to play out in Europe. Again, and this is more, as Peter and I started the discussion off, Richard, and you led us there, of course, was that there's so much complacency in the world. And yet these things are on the boil. And I know we haven't even gotten to the next topic you're going to go to, which puts it more. But Germany is still, they're an unknown yet. And it's the unknown is not because of anything really positive for Europe. It's a negative for Europe. So she's got to figure out just what's going to go on here and who's going to get one's post. And she's trying so hard not to give the Free Democrats with Lindner the Ministry of Finance, because then he'll really have a voice. And it's not going to be a pro-European voice. So a lot of things to be played out here. And as Peter has talked about, and where are the banks here? And I add to with him, not just European banks who have really so badly underperformed with this, and as the DAX has made all-time highs, and the stocks 50, the banks are way underperforming, as they are in Japan. I mean, I've been long Japanese stocks for longer than I care to admit, but at least I've had some dividend earnings, and they haven't done anything. But if things are so good, why aren't the banks rising there? We've seen fairly significant rallies this year in the U.S. banks, and that's, even with a quote-unquote flattening euro curve. So there are so many uncertainties there.
Yeah, I mean, just to quantify, the Japanese Topix Bank Index is still 20% below its 2015 high. I think the reaction in banks have basically repudiated negative interest rates and central bankers' desire to basically destroy their yield curves. And if banks are the transmission mechanism of this sort of policy, you wonder how central bankers can square the circle of damaging the profitability of the banks, but continuing on the same path of monetary easing.
Yep.
What about now the effect of Saudi Arabia? We've seen some incredible events happen over the last week, and given all the complacency, how could Saudi Arabia, what's evolving there, affect the financial markets and the global economy? Ira, do you want to start?
Well, I believe that, and this is, I've blogged about this the other day too, and this is truly one of my areas of great strength is the geopolitical events that are taking place here. And usually, if it's, it's like for the North Korea statement or North Korea, those are one-off things, and I always caution people, those moves, you can trade them, but don't look at them as anything longer than a one-day trade or two-day trade, because wars don't push gold higher. Wars, or let me say, not wars, but breakouts of some type of conflict. Those are quick one-off moves. But what's going on? And I go back to October 5th when we had a seminal event in international relations, which is that the king, not the crown prince, but the king of Saudi Arabia went to Russia to meet with Putin for the first time. And as I tongue-in-cheek say, it's like Nixon going to China. Very unexpected. And ever since that day, you can pull out a chart and take a look at it, oil prices have risen $8 in a steady upward beat. Now, and then you had what came out this weekend, but it's been a steady thing. The oil keeps rallying. It's not a headline grabber. It just, rallies. But there are movements afoot here. And the Saudis are very concerned about the Shiite influence throughout the Middle East. They're rolling Syria. They're rolling Iraq. They're rolling Lebanon. And then you had, of course, Hariri who is the Lebanese prime minister, who was in Saudi Arabia and resigned on Saturday night. Now, it really is interesting because Hezbollah actually assassinated his father, and Hezbollah is a Shiite militia and somewhat of a governing group that the Saudis are very worried about, as are others in the region, and that has now shown to be even more. And then, of course, he had a downing of a helicopter. So on the Yemen Saudi Arabian border with some high-level Saudi officials, supposedly we had a downing of a helicopter. As I say, it's like the Gulf of Tonkin. We don't know certain things, but there are movements afoot here. And that is, the Middle East is still a very significant area. It's significant for China, not as much for the United States as it used to be because we don't get as much oil there, but this is a very dangerous time. And again, the equity markets don't price any of this risk in. It's like, I watched Sunday night with what went on, and I was amazed that the markets, gold didn't rally. I was short gold, and I said, I'm getting out. I figured I was going to lose $10 or $20. It opened basically unchanged and went lower. I go, oh, this is a reprieve. I actually turned around and flipped it and went long. So, but the market, none of this, it's like if it doesn't occur on Twitter, nobody cares. But these are the type of systemic events that take place underneath the radar screens that will, when they start to be exposed, I think be phenomenally market moving.
Peter, do you see similar impact from Saudi Arabia, and what would be the effect on oil prices?
Well, I agree. I think Ira said everything there was to say. I just want to add on that what's going on with oil is, we've also had multiple years of a big reduction in the rate of investment in oil production, particularly offshore. You've had trillions of dollars of projects get canceled.
Yes.
And we've seen that also in the mining space, in the industrial metal space. That's what bear markets do. And that's when companies start to focus on returns on capital and cash flow. They spend less on drilling and mining. And I think it's really been the supply side that's been under more discipline that has created the lift in oil and industrial metals and this rise in commodity prices. So I think that's something to pay attention to, that, yeah, this is partly geopolitical, but I think there's been a concerted effort in trying to control at least the supply side. And even in the U.S., I think people are waking up to the economics of shale, and that markets aren't necessarily going to be so friendly to continue to finance all the shale drilling, where a lot of these companies aren't generating any cash flows. So while U.S. production will grow over time, I think a lot of it's going to have to be cash flow driven, and less of just the reckless spending just to drill a hole and create more barrels. So I think, just wanted to add that, sort of supply demand and dynamic on top of the geopolitics that I talked about.
And you know what? Peter brings up a very good point for another reason, but with the rise in oil prices has pushed the high yield debt of energy companies to the highest levels, not yield levels, but price levels. Mm-hmm. And yet, when I'm looking at JNK, the high yield ETFs, HYG and JNK, and those are both have moved underneath their 200-day moving averages, which is another warning. There are signs here that are developing, because what dragged them down, last year, or what sent high yields up was, of course, when the energy bonds and all the structured notes that they did were under trouble. But now they're rising in value, and yet the high yield indexes, the yields are rising at a time when that. So that's another one of these divergences that really is flashing for me.
Yeah, I agree. I think this rise in the cost of capital, and it's not necessarily on the long end, but you have to remember that the rise in short-term interest rates is a really big deal, because there's hundreds of billions of dollars of LIBOR-based borrowers that are seeing a rise in the cost of capital every single day with this rise in short-term interest rates. I mean, the one-year T-bill is yielding 152 today. The S&P 500 dividend yield is 1.9%. These are still obviously very low numbers, but in a world of many years of zero interest rates, all of a sudden there are alternatives here.
Mm-hmm.
And what Peter said, that's such a great point, that I can get 152, and I'm celebrating. I'm going to get 152 1 year. I mean, that's how sick the world is. I'm dancing. I'm doing a little jig because, whoa, 152,
Right.
It's like shocking to see.
Yeah, it's absolutely shocking.
Okay. And maybe we can end with your thoughts on New York Federal Reserve President William Dudley stated we had woefully inadequate regulatory regime in placing it as much better now. It is much better now, but there's still more work to be done to do. In reference to the financial crisis and what's happened since, Ira, you mentioned that was pure rubbish.
I think it's rubbish. I'm going to leave it. It's pure rubbish because the Fed had all the macroprudential tools that they needed if they wanted to put a halt to this, and I'll let Peter speak. I don't know whether he agrees with that or not, but for him to say that, I don't know what he's been reading, but him and I have been reading far different things.
Yeah, no, I think Dudley's comments reflect just an extreme level of delusion that Bernanke had as well, and that for them to, with a straight face, saying that it was regulation that was not in place that was the cause of the crisis I'm trying to think of the right word, but it's actually dangerous because they're deflecting any self-blame on monetary policy. I mean, monetary policy is the liquor that feeds the drunks. And for Dudley and Bernanke before to say, well, it was the lack of regulation that was the cause, is actually scary to hear because it tells you that they don't understand. They don't understand, or they don't want to admit the unintended consequences of price fixing the cost of money, and that typically goes awry, and it has in the past, and it is now, and it will again. And to think that it's a regulatory structure in place and that a bunch of bureaucrats are going to somehow manage the economy from that perspective and create these buffers around economic cycles is just, I don't know if it's hubris or just complete delusion.
Yeah,
really, that's like sums it up. And when somebody responded to that on the blog, and I wrote, look, at Greenspan, not only did he not try to curb it, he encouraged it. He said, use your house, use the rising asset value of your house as a piggy bank, refinance it, and create demand by spending the money that you can extract from this, taking on, of course, more debt at the same time. And number two, Bernanke, he didn't say, Peter rightly says, they fuel this. This is contained. There's no worry here. So what do you mean? They did nothing. I mean, on first blush, they could have raised reserve requirements to start squeezing the leverage that the banks were employing. They did nothing. Now, because in their own words, Greenspan said, when accused of, he said the same thing in the 90s. Well, how do you know it's a bubble? And what if we're wrong? Because monetary is a blunt instrument and you'll squeeze the entire economy. Well, you know what? Don't tell me that you didn't have the tools. You had the tools.
Yeah, exactly. Agree very much on those thoughts. Yeah. And that's great insight, gentlemen. How can our listeners learn more about your work, Ira?
Send money? No, Bitcoin.
Okay.
I post blogs at Notes from Underground, which you can find and register, and it'll come to you. But that's play a little humor.
Yeah, and Peter.
You can go to bookreport.com, BOOCK report.com, to see my daily writings, and also bookmarkadvisors.com.
Great. Thank you very much, gentlemen.
The FRA Roundtable Insight Show is for informational and educational purposes only. and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.